Hello, everyone, and welcome to this Rungta IAS Academy Explainer. Today, we're unpacking a massive geopolitical energy shock. It's an absolutely high-yield topic for your GS Paper 3 economy syllabus.
For sure. Welcome, aspirants. Listen, what we're looking at today isn't just your standard daily news update. It is a fundamental, structural shift in global macroeconomics. We have a ton of crucial ground to cover, so let's jump right into the analysis.
Right, let's look at this core paradox. The Middle East is caught up in severe tensions, and oil prices, well, they are surging. So you have to ask yourself, why is a major, historically stable player like the United Arab Emirates suddenly deciding to walk away from the OPEC cartel? I mean, this is exactly the kind of analytical contradiction the UPSC interview board loves to grill you on. Now, grab your pens and note down this number for your exam fodder: $111. Brent crude, the international benchmark for oil prices, has recently been trading at over 50% above its pre-war price. To put that into perspective, the market is unbelievably tight right now. Prices are literally soaring. And yet, in the middle of all this, the UAE is making its exit. And the current reporting clearly outlines the context for that price surge. We are seeing that the ongoing U.S.-Israeli war involving Iran has severely constrained our immediate oil supplies. The global market is, frankly, in panic mode right now. But to truly understand the UAE's move, we have to look past those immediate, flashy headlines and focus on the actual geography of trade. Spot on. And speaking of geography, here is an absolutely crucial location for your prelims mapping: the Strait of Hormuz. Because of the war in Iran, this critical waterway is currently closed off. Just think about the gravity of that for a second. 1/5 of all global oil supplies, including a massive chunk of the UAE's own crude, passes through this tiny, narrow choke point. It is the ultimate bottleneck for global energy security. Now, here is what's truly fascinating from an analytical standpoint. It's a stark contrast. On one hand, we've got this immediate, chaotic, war-driven supply crisis. But on the other, consider the UAE's specific announcement made via their state-run WAM news agency. They aren't exiting out of panic, not at all. This is a highly calculated, long-term strategic departure from OPEC. Let's break down their official rationale. The UAE is stating this exit is driven by a long-term strategic and economic vision, reflecting their evolving energy profile. Basically, they're accelerating investments into domestic energy and aim to gradually bring that additional production to the market, matched closely with demand. So they're officially leaving both OPEC and the wider Russia-led OPEC Plus group. And aspirants, make sure you note this down. Emirati Energy Minister Suhail al-Mazrouei specifically insisted this wasn't about some dispute with Gulf neighbors. It's pure economic strategy. Right, and it all boils down to shifting power dynamics. The daily oil production metrics show a completely changed landscape. The United States has radically reshaped the market, pumping out over 13 million barrels a day. Now, compare that to Saudi Arabia, producing over 10 million before the war, and the UAE sitting at 3.4 million. The U.S. has seriously challenged the traditional oil powers, and the UAE knows it needs sovereign flexibility to compete in this whole new ballgame, which perfectly illustrates the structural weakening of the cartel itself. Sure, OPEC still accounts for roughly 40% of the world's oil output, but its market power has undeniably been waning in recent years. Remember, over his 2 terms, U.S. President Donald Trump was a very steady critic, keeping constant political pressure on the cartel. The bottom line is, OPEC just isn't the undisputed kingmaker it used to be. Let's trace the historical timeline here to see the big picture. The UAE joined OPEC way back in 1967 through the Emirate of Abu Dhabi. Now, fast forward to February 28th, right before the current U.S.-Israeli war with Iran kicked off. They were producing around 3.4 million barrels a day. But here is the critical analytical catch. Analysts estimate their actual capacity is 5 million barrels a day. They've had this massive spare capacity just sitting idle because of strict OPEC quotas. And now, they finally want to unleash it on their own terms. Okay, aspirants, pay very close attention here. This is a golden quote for your mains answer writing. Jorge Leon, the head of geopolitical analysis at Rystad Energy, says, "A structurally weaker OPEC, with less spare capacity concentrated within the group, will find it increasingly difficult to calibrate supply and stabilize prices." Underline that phrase in your notes right now: a structurally weaker OPEC. That is your absolutely core analytical takeaway when we talk about market stabilization. Exactly. So let's quickly synthesize all of this into your core GS3 mains takeaways. Number 1, OPEC is losing a crucial member with that rare ability to quickly raise production. 2, The UAE is going to act independently now, supplying the market based on measured demand. 3. The cartel's overall bargaining power is fundamentally weakened. And 4. Despite all these long-term macro shifts, global prices will stay highly vulnerable to geopolitical choke points like the Strait of Hormuz. I want you to structure your exam notes precisely around those 4 pillars. What a perfect summary. To wrap up this explainer, we are leaving you with a mains practice question to really test your grasp of everything we just covered. Here it is. In light of the UAE's exit from OPEC, critically examine the structural weaknesses of global oil cartels and their impact on energy security. Take 15 minutes today, apply the exact analytical framework we just discussed, and write this out. Practice is how you conquer the mains. Keep studying hard, stay focused, and we will see you in the next session.